bring in our headliner now. Just ranked #1 in both portfolio strategy and quantitative research this year by Institutional Investor. Inducted into their All-America Hall of Fame list, he is Dubravko Lakos. He's the Chief Global Equity Strategist at JPMorgan. Congratulations.
Thank you.
Good to have you back.
Thanks for having me.
All right, so by virtue of these accolades, your point of view matters to a lot of people. You heard Jim suggest that the economy is doing much better than people think it is. You're one of the doubters, in some respects, about where the economy is going. So let's match this up.
Yeah, absolutely. I am one of the doubters. I've been a doubter even the last time I was here on the set when the market was higher. So for us, macro is really like the big headwind that markets are facing. Higher for longer, cost of capital being elevated is something that we've been talking about since February. Liquidity is getting sucked out of the system as well, which I think is generally a pretty big and important headwind. Obviously, there's geopolitics that we can talk about, but that's also an additional tail risk that's very hard to sort of handicap. Fundamentals, to your point, I agree. I think I see them slowing. They're just not collapsing. And the word that I would use on the fundamental side is we're seeing increasing bifurcation on the fundamental side.
It sounds like the crux of your argument is built around the idea that the lag effects are going to be more dramatically felt than people realize today. Fair?
Yes, very fair. I think there's just a lagged effect, and this time around in this cycle, the lag simply may be longer than what we're accustomed to sort of seeing in the prior cycles because of the unprecedented injection that we've got during COVID and because of a relatively healthy starting point for things like balance sheets.
Jimmy? I want you to respond, and then I want Steph to also, because you guys have a more sanguine view on where we are relative to Dubravko and some of his colleagues over at JPM.
Okay, Dubravko, always good to see you. Thank you. Look, for the last year and a half, I think you'll agree, the economy's done a lot better than expected. And let's just chalk that up to the lagged effects being a lot more lagged than any of us expected. All right, let's just say I give you that, and we can disagree about the path going forward, but these companies that during this extremely long lag time have out-earned, and cleaned up their balance sheet, doesn't that actually perversely extend the lag further from the point of view of they have less debt to refinance, right? I mean, that's what we're worried about, at least at the corporate side, is they're going to have to refinance at these much higher rates, except now there's a lot less debt because they've paid down a lot with all the extra cash flow. Is that right?
Yeah, I think that's broadly right, but I think that's just one part of the picture. I think for the S&P 500, for the large cap complex, balance sheets are in a pretty good spot. Rates going higher is a headwind, but just a gradual headwind. The problem is, I think, as you move down the cap spectrum, you look at mid caps, small caps, the entire private sector, there's a more significant portion of that that's variable, that's more sensitive, if you will. Balance sheet is more sensitive to cost of capital. And everything that's happened so far during this, call it increasing headwind from cost of capital, has happened under a relatively healthy top-line demand type scenario, where pricing power has been strong and where a lot of corporates have been basically growing not organically, but just through price.
Dubravko, forgive me, why aren't companies laying off people?
I think that's the lagged effect. I think that's a risk that we're facing in 2024. I'll give you one statistic. S&P 500, if I'm not mistaken, which is right, the fortress balance sheet employs only, I believe, 12, 13 million people. If you look at mid-cap, small-cap, private sector, you're looking closer to 60, 70 million. And that's the area that's more vulnerable to the macro headwinds.
Small caps are in a bear market already, though. Like, what if a lot of what you're saying is true and priced in? The Russell is not the S&P.
I think things are definitely getting priced in, but to me, that's a worrying sign. To me, that's a sign that the market is telling you things are slowing down. We're hanging on to the Magnificent 7, Magnificent 11. All the returns this year are coming from basically 7 stocks. So that's telling us. So I think, yeah, we better hope that the NVIDIAs of the world keep just really rolling in very, very strong numbers. The second that goes, what do you hang on to?